For more than a decade, the architects of the global economy operated under a dangerous delusion. They convinced themselves that money was permanently free. Central banks artificially suppressed interest rates to zero, pumping trillions of newly printed dollars into the financial system to bypass basic economic law. After years of flatlining, the sudden increase in money supply triggered a violent surge in inflation. To fight it, the Federal Reserve aggressively hiked interest rates, chasing the curve upward. As rates spiked, the foundation of the global financial system, the U.S. Treasury bond, crashed. Hundreds of billions of dollars in bank capital quietly evaporated, pushing the global economy to the absolute edge of a systemic collapse. Welcome back, makers. Today, we are dissecting exactly how this $34 trillion debt spiral was engineered and why the safest asset in the world became a toxic liability. Look at this chart. This long, flat baseline represents the 0% era, a 14-year period that built a psychological trap based on a single concept: safety. In high finance, United States Treasury bonds are considered the bedrock. They are the designated safe haven for massive pools of capital. The logic relies on a simple premise: the United States government can always print more dollars to cover its obligations. Therefore, it mathematically cannot default on its debt. Because of that absolute guarantee, megabanks, national pension funds, and foreign governments routinely park billions of dollars in these bonds. This unquestioned systemic trust meant that institutions viewed government debt as completely flawless, creating a massive blind spot to any other type of risk. After the 2008 financial crisis, central bankers panicked. The resulting economic shock terrified the Federal Reserve into altering its monetary policy entirely. They initiated a policy of quantitative easing and rapidly slashed interest rates to zero. They held those rates down for over 10 years, creating an environment where institutional borrowing and capital were practically free. During this period, an enormous technology boom generated an unrelenting wave of corporate cash, flooding commercial banks with massive deposits. Then came the 2020 pandemic. Government stimulus checks and corporate bailouts served as a secondary, massive injection of cash directly into the financial system. Commercial banks faced an operational crisis. They were legally obligated to hold these billions in customer deposits, and they desperately needed to put that money somewhere that offered a safe yield. The banking sector landed on a uniform solution. They took that excess cash and bought massive volumes of long-term U.S. Treasury bonds. Incoming cash deposits were immediately converted into 10-year and 30-year maturity lockups. But because the Federal Reserve was suppressing rates, these massive blocks of locked-up capital generated a microscopic return, yielding only 1 to 1.5%. Banks accepted these poor yields because they completely relied on the Federal Reserve's public assurance that high inflation was a thing of the past. If you operate under the assumption that inflation is dead, locking away billions of dollars for a decade at 1.5% appears to be a mathematically responsible decision. But beneath that apparent safety, a hidden interest rate risk was forming, an invisible structural flaw buried deep inside these highly trusted assets. The banking sector projected immense confidence, completely unaware of just how fragile and sensitive their bond portfolios had become. When inflation eventually surged back into the economy, that foundational premise shattered. It proved to be the single greatest miscalculation in the history of banking. By 2022, the multi-trillion-dollar expansion of the money supply reached a breaking point. Consumer prices, which had remained stable for decades, began climbing at the fastest rate in 40 years. This spike in the cost of living directly eroded the savings and day-to-day purchasing power of middle-class households. Faced with a potential loss of control over the dollar, the Federal Reserve initiated an aggressive reversal of their previous policies. They began raising interest rates at a pace that caught the market off guard, moving from near zero to over 5% in just a few months. For over a decade, banks had operated in a world of essentially free money, leaving them unprepared for such a rapid transition. The very mechanism the Fed used to cool the economy was simultaneously creating a structural imbalance inside the world's most stable financial institutions. Much of that banking stability relies on U.S. Treasury bonds. These are the primary assets banks hold because they are backed by the full faith and credit of the government. When interest rates were at historic lows, banks bought hundreds of billions of dollars in these bonds, which paid out a fixed yield of roughly 1%. The value of these assets is governed by a fixed mechanical rule. When interest rates in the wider economy go up, the market price of existing bonds must go down. Consider a bank holding a bond that pays only 1% interest. If the government suddenly begins issuing new bonds that pay 5%, the landscape for investors changes instantly. No one will pay full price for a 1% return when they can get 5% for the same level of risk. This left banks holding massive quantities of older, low-interest bonds that were suddenly worth much less than what the banks originally paid for them. To find a buyer for those old bonds, the bank would have to sell them at a steep loss to make the yield competitive with current rates. As the Fed continued its rate hikes through 2022, this mathematical reality began to show up in the open market. Even though these were government-backed assets, their market value was no longer stable. Market data for long-term treasuries showed a decline of 20 to 30%. This represents a historic loss of value for what is meant to be a risk-free asset. The volatility of these bonds mirrored a major bear market in stocks, rather than the steady behavior expected of a bank's reserve capital. These are the types of losses typically associated with speculative investments or failing companies, not the core holdings of the global banking system. This loss in value wasn't a result of bad credit or defaults. It was the inevitable result of the sudden change in interest rate policy. By the end of 2022, these declining values had created a massive hole in the balance sheets of American financial institutions. The Federal Deposit Insurance Corporation reported that the banking system was carrying over $600 billion in unrealized losses. An unrealized loss exists only on paper, as long as the bank holds the bond to maturity. But if a bank is forced to sell that bond early to get cash, that paper loss becomes a real permanent deficit. Because the market value of their assets had dropped so far, many banks were essentially insolvent on a mark-to-market basis. This functioned as long as depositors kept money in their accounts. The moment a bank faced a sudden need for liquidity, the pressure became unsustainable. Silicon Valley Bank was the first major institution where this pressure became public. When their clients began withdrawing cash, SVB was forced to sell their Treasury bonds to cover the requests. Because rates had risen so far, those bonds sold for significantly less than their face value, forcing the bank to book a $1.8 billion loss. That loss signaled to the market that the bank's capital was gone, triggering a modern bank run that ended in total collapse within 48 hours. While SVB's specific client base made it vulnerable, the underlying devaluation of Treasury bonds remains a reality for thousands of other banks across the country. The collapse of Silicon Valley Bank exposed a fracture in the banking sector, but a far larger fault line is opening at the sovereign level. The United States government is currently caught in a mathematical trap of its own making. The national debt has crossed a threshold of $34 trillion. To keep the government functioning, fund overseas conflicts, and cover massive deficit spending, the Treasury has to constantly issue new bonds to pay off the old ones. The entire system operates as a continuous financial treadmill. This pie chart shows the distribution of United States debt, specifically highlighting the proportion held by foreign nations. As those foreign slices actively shrink, the government faces a harsh reality. The traditional buyers are walking away. For decades, the United States relied heavily on major economic powers like China and Japan to absorb its bonds. This endless demand effectively subsidized American deficit spending. Without those foreign nations absorbing the debt, the primary mechanism the United States uses to fund itself is breaking down. A coalition of foreign nations is actively coordinating an exit from the US-dominated financial system. Global leaders are deliberately decoupling their economies from American influence. Global central banks are executing a massive offloading strategy. They are dumping their US dollar reserves at the highest rate in recorded history. When global trade no longer requires the dollar, the United States loses its primary economic leverage. The ability to dictate terms through sanctions and currency control begins to evaporate. To replace the dollar, central banks are aggressively hoarding physical gold. capital is flowing into tangible wealth that a central authority cannot print or debase. The aggressive acquisition of gold paired with the dollar sell-off points to a clear conclusion. The global market is structurally abandoning the American financial model. With a shrinking pool of foreign buyers, the United States government is forced into a corner. To attract domestic investors to its debt, the Treasury must offer increasingly higher interest rates. This line chart tracks United States defense spending alongside the government's total interest expense. Because of these high rates, the annual cost to pay the interest on the national debt has surpassed $1 trillion. As the interest line aggressively crosses over, the scale of the problem becomes clear. The interest alone now costs more than the budget of the entire United States military. This dynamic creates the first half of a mathematical doom loop. To pay these massive debt obligations, the government prints more money, directly driving up domestic inflation. High inflation then forces central banks to hike interest rates to cool the economy. Those higher rates make the national debt even more expensive to service, forcing the government to print even more money to cover the spread. Every mechanism used to fix the problem directly accelerates the currency's decline. The system is trapped in a self-perpetuating spiral. Systemic cracks at the sovereign level eventually reach individual portfolios. The era of 0% interest and free money has ended, and severe financial consequences are now working their way through the market. Rule number 1 is to transition capital into hard assets. When a government attempts to inflate away its debt, paper currency loses purchasing power. Wealth must flow into real estate, commodities, and tangible assets that cannot be digitally reproduced. Rule number 2 is to avoid long-duration debt. In a highly volatile rate environment, getting locked into long-term bonds or fixed income traps reduces your ability to react. Maintaining short-term liquidity is essential. Rule number 3 is to calculate the real yield of your investments. If an asset pays 5%, but true inflation is running at 7%, your capital is being quietly taxed by 2% every year. Always factor in the hidden cost of inflation. The crisis in the bond market is already unfolding. These structural failures are heavily impacting global liquidity right now, demanding immediate vigilance to protect your capital. Ignoring mathematical realities inevitably destroys capital at the highest levels. If you want to see exactly how a lack of financial discipline can erase billions, click the video on your screen, where we break down the most disastrous corporate merger in history. Stay vigilant.